eForum Fireside Chat. Today, we are pleased to speak with Reuben Munger, founder, managing partner, and chief investment officer of Vision Ridge Partners. Reuben is recognized for his expertise in electrified mobility, renewable energy, and transformative real assets, and serves on multiple boards in the sustainability and investment space. In this conversation, we will explore the firm's investment philosophy and strategy, discuss the evolving role of private equity in the global transition towards sustainability, and conclude with reflections on the experiences that have shaped his perspective and approach as an investor. Reuben, thank you so much for taking the time and joining us today.
Thanks so much, Khaled. It's fantastic to be here.
Vision Ridge focuses on transforming complex assets, as you say, rather than simply financing green projects. Could you please tell us what this transformation means in practice with your investment process, and how does it create a differentiated value for investors?
I think that's a fantastic question to start with. It's really at the fundamental heart of what we're trying to do is living within these existing very complex systems, whether it's mobility, agriculture, or energy and power. The system functions, it functions well, but it is in this phase of transformation. And so we look at two different things, right? One is where are there businesses or asset categories that are not yet at scale, and where bringing them into the system is going to change things around them. And so those platforms are often, shifting the way the system works. So you're taking a low capex, high opex vehicle that's a traditional ICE vehicle and turning that into an electric vehicle, right, which is much higher capex, but has a very different operational profile. And so it is partly a financing question, but it's also the system all around it where you need to provide fuel. And no longer can someone just drive to a gas station. And so you need to be able to adapt to where can you deliver what you're really doing is mobility. Right? The customer needs the vehicle to operate. And so that's an example of a complex system. And then, on the other side, something more in the buyout space where you may have a great green transition. By nature, you're taking an existing system and having to adapt it. And that's this framework where things that may have been unbundled in the current economy, you may be bundling back together because they go hand in hand with the transition.
Within your strategy, you target sustainable real assets, but across energy, transportation, and agriculture, as you mentioned. How do you determine where along these value chains the most attractive risk-adjusted opportunities lie?
I've always been from the background where, you may have themes and theses that come top down, but opportunities sort of gestate bottom up. And what we're doing is we're living in these changing systems and trying to see when and where you're close to an inflection point where you can create scale. And over the past 10 or 15 years, the scale that we're talking about has expanded tremendously, and the economic opportunity has expanded as well, right? So costs have come down a ton, and that means where those inflection points has continued to shift. And so where we like to spend a lot of time are what are critical friction points and what are the levers around that friction point. And so using both transportation and energy as examples, right? The grid is a constraint in both cases. And so how can you use an interconnection of a power plant to bring more technology or more energy or electricity through that power plant? That can then play through a number of different things as technology and costs change. Or how do you connect something to the grid at the distribution layer to charge a vehicle, and how does that interact with the system? And so what we try to do is be acutely aware of when things might be a little too early, and yet by being early, you become an industry leader at a remarkably small scale. And so we had a platform that became the organic recycler of the year and partnered with all of the biggest CPG companies because they were number one at doing what they did, because they were first, right? They did a good job, but also by being early, you can get kind of an industrial presence that allows you to scale and gap away from the second or third player, and we see real value in that. And so it is trying to be very focused on value protection and kind of what are those sources of downside mitigation that come from living within infrastructure and real assets, where you own a physical asset that has cash flow. And so how can you use that to protect risk while sitting at the inflection points that allow you to scale into something much, much larger?
Many climate investors focus mostly, let's say, on venture and growth equity. At Vision Ridge, you emphasize, its asset-heavy platforms and infrastructure. What advantages and you would say also risks would you see in this real assets approach, especially in the opportunity side and the advantages when you scale towards a low carbon economy?
I think you've hit that just right. Many folks bias towards venture capital. We've seen climate-oriented venture capital can be quite hard because you are actually running into the problem that we try to live on the other side of, right? In order to manifest low carbon technologies or reduce the carbon intensity of the real asset system, you need to deploy it physically. And so where venture capitalists often run into problems is they're taking technology risk and then asking later stage investors to take that same technology risk to build at scale those first assets. And so we try to do two things, right? One is to mitigate risk. We really focus on things that have been more proven. We're not trying to live in that first of a kind sort of opportunity, because that is much more of a venture capital binary risk. And so that's a risk we really have to mitigate and focus on, which is this a replicable, scalable, deployable opportunity? And if you take, something as simple as solar power plants are actually have the highest probability to deliver on time and on budget. And if they do deviate, they still have the lowest deviation cost of any infrastructure in the world. And that's a sort of a robust book and study shows that. And so doing things like that have really attractive risk skew as opposed to some of the early stage technologies that need to be built. But also because this manifests in the real world, right? That is where the change has to happen. It can't happen in the lab, and software, as an example, can only make so many changes. And so in order to achieve effectively the impact goals, you have to live in the real world. And yet the complexity of the transition is what we see as the outsized return opportunity. And so for us, it's a really clear sweet spot where by deploying these things into the system and into the world, you're making physical, tangible, real impact. But also because those things are what they are, physical, tangible, cash flowing assets, you're protecting capital. And as you innovate, you're creating expansionary pathways for others to potentially buy the assets that we've de-risked and kind of take advantage of leading categories to the extent we've been able to create category leaders. Right? And so that, to us, is what creates sort of a really attractive skew with limited downside and strong upside opportunities in climate in an otherwise complicated investing space.
I mean, it's very clear that you look at building platforms versus just making an isolated investment. If you could, clarify to us how you identify when, one asset can become the foundation of a scalable platform versus, just acquiring a single asset.
So we haven't gotten this right every time, but when you don't find something that scales, you can risk manage. And when you do find things that scale, you're able to deploy more and more capital into the things that are working, which is a very attractive portfolio point. But where we spend a lot of time at the beginning is, if it isn't scaling, how do you protect capital? And then more importantly, why is this the time and place where it can scale? And so whether it's in renewable natural gas or utility scale grid batteries or electric school buses, or sort of the list goes on for us, but it's finding seams where you are at this place where scale matters, and then you create a business where not only are we able to contribute additional capital at attractive returns because you've created a effectively that business creates a capital deployment moat around higher return opportunity. You then can sell that to someone who wants to pay for pipeline in a way that is different than just paying for assets that you may have built at an attractive return, and you sell it to someone with a lower return on capital. That's step one of making attractive returns for us. But step two is, to the extent you get a platform, that platform can then have real payment for proprietary pipeline. And so that's kind of the third leg of our return stool, which is protect principal at the core, build things with attractive returns so that you get those yields no matter what, and if not, even better, you sell to someone with lower capital costs. And then the third leg, which is when things work really well, is that platform that has captured a replicable way to deploy capital with excess return embedded, and people pay for that.
You've recently closed a fund, and so as your firm, raises increasingly large funds and you expand globally, how do you preserve, the disciplined sourcing and operational engagement that define Vision Ridge in the early years?
It's a funny time where we see the opportunity set is as or more interesting than it was 10 or 12 years ago when we started, but it's driven by the change at scale. And so while our access to capital and the size of our funds have grown, the size of projects are also growing. And so we may have done something very interesting in solar in 2013, but it was 20 megawatts and $20 million. And now we already have something in the portfolio that's 1.8 gigawatts. And so those are just remarkably different scales, but it's the economic system that's driving the answer. And so to us, the first step is have a pool of assets that are appropriate for the opportunity set. And then as things get bigger, you are able to manifest more experienced management teams, deeper management teams, and that has led to us building out more and more of an asset management capability, more akin to other sort of, as private equity firms mature, they often tend to build these capacities in-house, and we're doing that. And partly it's also to capture and bring on the people that we've worked with in the past, where when this was a nascent asset class, all your friends were sitting around ready to work with you, and now they may have been hired by a large multi-strategy alternatives firm, and so you need to be a little bit more active. And so as an example, we brought on one of our former CEOs as an operating partner and continued to lean into those things so we can add more value in the portfolio while we live in replicating themes in areas where we've spent a lot of time, but can now live at the sort of scale that the market and the system is dictating today.
If we move along to the role of the global transition to sustainability from a private equity perspective, I mean, you founded Vision Ridge in 2008, long before climate investing became mainstream. Do you see the opportunity has evolved, and also what is the perspective of LPs towards this type of investment today?
I mean, it's been great, right? If we think about our fundamental mission, which is, we see through superior returns the opportunity to catalyze capital to address climate change, and that means finding specific investments that need capital and can return capital in an attractive way and make a difference. As a firm, we see that as well, and obviously we've talked about our growing fund sizes and other ways to bring more capital. But at the industry level, right, that's also fundamentally important. We want more people who understand how the system works. More competitors may, at the margin, make things a bit more complicated going in, but it also means there are more people informed and willing to buy your assets when it is time to sell. Further, the industry has moved a long way in understanding the trade-offs, in measuring those trade-offs, and in communicating them, up and down the value chain. And so, as you talk about the cyclicality of enthusiasm, it is much lonelier today than it might have been 3 years ago. But that's just an opportunity to invest and to lead into what we see as really interesting opportunities. And at the same time, everyone's game has been improving, right? And so whether it's impact reporting or value-added activities within the portfolio, competition drives improvement. And so to us, we see more folks around the table making a difference. And then on the LP side, I think there are a couple of, we've always had multiple types of investors where there are regional differences in how they may want you to report and think about impact and climate, where US institutions have one standard and goal, and some foreign institutions might be more interested in the reporting. And at the same time, if you go back to our mission, right, our goal is to deliver returns. And if you deliver attractive returns, the additionality of positive outcome is seen as a real plus. And so, in some ways, you kind of have to execute on job one. But if you kind of go back to a broader landscape of how do you deliver competitive advantage in investing, right? There are a number of really smart, really hardworking people in our industry. And so it's by being specialized and being within this sector and being deeply committed to it that we attract a great team, and then can begin that process of a flywheel of investing in adjacencies where we're learning from the things we've done before, and that makes us the best partner for someone who wanted to do things. And so that's the way that we see the kind of competitive evolution being a real positive to what we're trying to do.
And beyond the financial performance, there's also the need for a measurable environmental impact. Is it still the case today? And how would you say that the industry needs to balance this genuine impact with the pressure to scale capital?
I mean, I think if you scale within impact is good, and as I kind of had mentioned before, right, you need returns to justify your existence. You need to be able to deliver opportunities that are attractive, risk-adjusted returns. And like many industries, those things are going to go in a cycle as well. But the attractive part is people are better and better at reporting, at measuring, and thinking about these issues, and yet there's still real work to be done, where things like avoided emissions are very hard to measure. They aren't well standardized. And so, we have a head of impact, Pete Murphy, who is, really engaged in that conversation. And it's part of what drew us to bring him on the team is how can you engage in evolving that question so that, I'll pick on that electric school bus business where you are actually creating scope 3 emissions because you're buying a school bus, but it's electric. So you're actually generating much less emissions than you would with a diesel school bus. But that is not yet an industry standard measure. So you have the emissions of buying the bus, but you don't actually have the relative value created of it being, less CO2 emitting, the behavioral impacts of kids going to school less rambunctious because they've been on a quieter bus, their quality and health impacts of them not having the particulate matter. All of those things are hard to quantify, but are motivating to make investments, and why, when you find something that can scale and be an industry leader, it is quite fun.
There's always a saying that one thing to reach a net zero or sustainable economy puts the US or the Western Hemisphere at a disadvantage at the time where they need to reindustrialize and compete, let's say, with China. Do you agree with this view?
I think you need to drive a cost-driven, long-term approach to infrastructure and sustainability. Some of the fastest changes in the light duty, meaning the passenger vehicle fleet, has been in third world countries or emerging markets, right? Uruguay is suddenly deploying electric vehicles at an incredible pace. And it's because of the cost of gasoline there and because of the cost of Chinese EVs, right? And so the global export market is enabling them to make a change. They're faster than we are right now. So it's not about some global net zero mandate. It's about the economics of being able to buy a better product at a better price that also is more economically advantageous than the alternative. And that's where we're really sitting and pressing against. And so I think it's almost like an old narrative where much more open field, playing allows the change to happen faster, right? If you think about what is the leading state in the U.S. for solar, right, is Texas. It's not California. It's the most deregulated market is the place where actually there's the most change because it's purely economic and purely price driven. And so that's just a different paradigm than where we sat 10 or 15 years ago. There are a series of policies that are important, and those often go to importing or exporting of fossil fuels, right? A fossil fuel economy is more volatile and more exposed to, particularly right now, right? We're seeing the exposure and the impacts to global disruptions, whereas, if you're charging a solar panel on the top of your house and that's how you're then charging your car, you don't really care what the price of gasoline is on any given day. And so I do think that there are really interesting evolutions of volatility, change, and security and economic robustness that come from an energy transition, but this middle transition is quite hard, and issues are exacerbated today.
Many climate solutions not only depend on the technology as you mentioned it, but also on regulatory frameworks, grid modernization, and industrial transformation. How do you navigate these systemic dependency, and especially when it comes to the regulatory side?
I mean, one of the places that we've often field questions around regulatory and policy changes, and I think it's both it's unfair to not name that as a truth across all things energy, as an example, right? Electricity is fundamentally heavily regulated, as it should be, right? It's a fundamental, the distribution grid is likely best a monopoly. And so, the frameworks of how that happens have been a series of regulatory choices in almost every country in the world. And so how low emission technologies interface with that and achieve the system-wide goals, are always going to be intertwined. Over the 15 plus years that we've been doing this, in general, the policy trends and changes have been tailwinds. They haven't been, consistent, right? And I think that's in some ways, I would trade less tailwind for more consistency, because these things are hard to build and take real time. And so when you're making a multi-year build commitment, you're having to forecast forward what is the state of the environment that you're going to be operating in when you're ready to come online. And so I think there's a lot of discussion on both sides of the political aisle around permitting reform, those kinds of changes. And so we see that as fundamental to what we're trying to achieve, and it exists kind of around the world. And so you kind of embrace those issues, and you work to understand where and how you have enduring economic advantage so that you're not sort of at the whim of a given policy.
You have within your portfolio areas that link between sustainable agriculture and mobility, and this is something that's not very common among energy transition investors. Could you explain to us how interconnected these sectors are, and how do you achieve your financial returns through that, but also how does it move towards a more sustainable economy as well?
Yeah, I think the interconnection between energy and transportation is relatively straightforward, given electrified mobility is effectively, not to use the pun, it's an interconnection issue, right? And so you really are living at a very similar set of constraints and opportunities in power and in the power system. Agriculture, you're right, is a bit of a different angle on the question, and yet how we can feed a planet of 8 billion people where carbon emissions are an important part of the food supply. And so when you kind of think about natural capital, what are the mechanisms of opportunity and risk within natural capital? And so we've seen water as a fundamental challenge where investing in infrastructure there can create more enduring and sustainable agricultural activity. And that's really important to feeding people over time. And so, it's an example where our work and our thinking around water as really a nonlinear and a non-correlated investment that's outside of some of those the sort of regulatory and economic cycles that we've just been talking about, is a real attractive, diversifying opportunity. And so, the second layer is, where can you find replicatable insights that do work on creating both interesting investments and interesting, kind of decarbonization or climate-oriented pathways to either mitigate or be adaptive to climate change. And I think in a lot of ag, there's also a lot of thought about how to be adaptive, because changing climate zones are having real impact on crop yields and other things. And so it's an area we keep working on and thinking about. And occasionally, I guess the one other piece is, as an example, as water scarcity has become more and more important in California and the U.S. West, there are spaces that may be better prone to farming electricity with solar panels than farming cotton or tomatoes or something that is effectively using a subsidized water program to farm. And so when you look at an agricultural opportunity, part of your asset rationalization may in fact be engaging in renewable power or other electrified opportunities. And so that's where you really start to see intersection and interconnection. One of my partner Justin's first renewable investments was buying a carrot farm. And that carrot farm became the land under the largest solar power plant at the time. And so that's an example of downside protection, where you have the yield of farming and the upside of it becoming an energy asset.
But what structural change do you believe will redefine the way private equity allocates capital to sustainability-driven assets?
We still believe that there is a structural and secular transition to assets being increasingly sustainable. And that means that all investors are going to continue to think about and see this as an opportunity set. And that isn't to say that there won't continue to be thermal-oriented or oil and gas investing over time. The businesses that created tetraethyl lead, which was the lead additive to gasoline, kept going for years and years and years after we banned it in the United States. So things change slowly, to your point. But where is marginal investment, and where is that opportunity set for marginal investment? And I think we'll continue position. I think you can, it is both a long tail, as you described, but you may also see transition accelerating, where certain things may hit tipping points or change structures, where what we are seeing, and unless you've been sleeping too soundly, right? Like the interest in power and electricity is different than it's ever been. And so we are going to be making a set of commitments in the system over the next 3 to 5 years that will have longer term implications to how the system functions. And so, you may have some reinvention of stranded assets or other things that will take 20 years to play out because of the duration of the assets that get built. But that just means that sort of how the system is going to change will continue to, I think, evolve, but evolve more quickly on that 5 to 10 year view, while feeling painfully slow on the 6 to 12 month view. Right? Like if you're living within a permitting process in any jurisdiction in the United States, you feel like it's painfully slow, and yet in aggregate, you may see a lot of change.
When you launched Vision Ridge, what was the single hardest part of raising your first institutional capital? And, how did this shape the way you think about building trust with investors and LPs?
So, in some ways, we were fortunate in that we had a fund when we went to market, because we spent a long time working with 2 families that saw our theme and our thesis. And so we did our first close effectively before we went to market at all. And what that means is we started the firm with a investor-focused framework, right? So our 3 largest LPs were our team, a foundation affiliated with Jeremy Grantham from GMO, and Capricorn Investment Group, right, which is also a family office. And so we spent our time focused on what is the right way to align to long-term owners. How do you invest while we have a traditional duration structure? How do you invest like you're going to own something forever, and effectively then look for opportunities to exit in ways that you enhance returns, and kind of build an investing approach that does fit with the long term, right? And so that's where we started. We also then came out with a set of structures that were biased towards our anchors and our framework. And so we went through the process of engaging with institutional investors, wanted to do something in climate that they thought was impact oriented as a new team with a series of other complicated provisions. And so we got really good at hearing no in that first phase, and are deeply grateful to the institutions that did come into our second close to build the fund and the firm, right? And so we have deep loyalty to early investors. We understand that it takes work to engage and to adapt and to kind of deliver results. And at the end of the day, that's the key to us. Is I think a lot of our growth since then has been because right, we have three jobs, right? We do need to raise capital. We need to invest in it and manage our assets in a really good way. And then the third one is we do need to sell things and realize and return capital. And so, we're focused on all three of those things. And if you keep delivering on that fundamental piece, that gives you the right to also make sure that when you are making investments, they're impact positive. It allows you to invest as a team in measuring that and delivering that as information. And so, that becomes the DNA of what are the ways we uniquely add value to create, the simple version of returning capital, but doing it with attractive risk structured portfolios. But that comes from that beginning of having a couple of families that said, we're willing to go on this journey, and now we have some of the largest allocators in the world as our partners.
Many investment philosophies are forged through few defining deals, and many private equity firms, are really have their signature deals that symbolizes what they think and their path forward. Would you mind sharing a transaction, that forced you to basically rethink how you evaluate risk and value creation?
So, it's always hard to pick, a single favorite. But when we look at platforms that we've grown, so whether it's Vanguard or Key Capture or Highland, we do really see the value of leadership, the value of leaning in with your management teams as things go evolve, right? A growing platform is not a consistent operating journey. And so how do you be flexible and get the right team in place in the right category in the right way to take advantage of where the markets evolve? And so, in Vanguard, we built the business with a focus on selling electricity through a particular net metering architecture in Massachusetts, a very wonky little micro niche. But when that went away, it actually opened up the business to be much bigger than it would have been otherwise. And so when kind of the path to growth got constrained at 4 or 5 assets, you actually unleashed creativity. Similarly with Key Capture in batteries, a heavily contracted portfolio became merchant through a process of storm impacts and kind of changes in the Texas market. And so suddenly having a merchant portfolio was much more interesting than having a contracted one. And so how do you lean into those changes and have the team around you to adapt and change as the markets evolve, so you can really create industry leaders as you walk along the kind of path of emergence, I think has been where we see the highest value creation. And then I can't get away from the great green transition, where something like Fjord 1, where we bought the largest operating fleet of ferries in Norway through a $1 billion take private, and transitioning those to electric, and kind of using our broader knowledge to help the family that owned the business with us make that shift, where it then became a very straightforward infrastructure asset. And that pathway and change was kind of fundamental to what we see as the opportunities of bringing battery and charging expertise with kind of transactional creativity gives you lots of opportunity.
And over the course of your career, do you feel that your approach to identifying great investments has changed, or is it also always the same type of signals that attract you to an opportunity?
I mean, I think if you go all the way back, even when I was more in public markets, right, that we fundamentally always believe in risk management and capital protection and looking for real attractive skew. And so that's been kind of fundamental, since I was 2 years out of college, as what we look for in investing. How do you bring a creative and flexible mind to a situation? And that continues to be a core throughput where we may have a thesis or an idea on our side, and we're then looking for the management team and business opportunity where there's the right level of overlap to fit our capital. And sometimes you might find a great team, but they're too expensive, or you might find the right asset category, and you need to work to find then the right way to express your investing framework. I do think we continue to ask that question, where is our insight and the investment we are then going to make the exact right thing to line up. We have something I think we'll do in the next 30 days or so, maybe 2 months. It's the first step of an insight. If it precluded us from doing something else, we might not be doing it, but we see it as accretive to adding to more and more things in the sector. But we do need to think through what are the best ways, I think more than we used to, what are the best ways to implement an idea, and what's the right scale at which to do it, because the scale elevator can range from a $50 to $100 million platform that you might get a really attractive multiple on, to a very large but more robust and resilient cash flow stream that has some optionality, but is therefore, because it's big and cash flowing, it is also likely to have lower aggregate returns.
Speaking to different investors, they sometimes tend to mention that when they do an investment, they don't necessarily think about the exit straight away. For you, is it something, especially in private equity, where today, DPI has become a frontline topic? For you, how does the process arrive? Is it to invest in a good company and good team and to push it forward, or from day one you already have your eyes set on the exit?
I think the biggest question for us is, our top buyers tend to be infrastructure funds or strategics that look like infrastructure funds, a large public utility or something like that. And so it's less what is our exact exit, but what is our journey to be of the right risk profile that they will understand and they will pay their versions of multiples, so that we don't underwrite an automatic change in multiple, but we want to see the pathway for why that is possible. And so, our baseline hold it forever or our baseline framework doesn't say we're going to get multiple change, but we do want to understand that question, because time after time after time, that's our exit market. And so we do want to know going in why this thing that is attractive today to us is going to be attractive tomorrow to them. And what do we do on that value creation journey to create that platform or that set of assets that fits someone else's risk profile, and therefore someone else's.
In high stakes decisions, when you have incomplete information, is this something that that you face throughout your career? And if so, how do you manage it? What does it teach you, basically?
I think it is kind of a funny question for someone that, I spent over a decade in public markets before becoming a private markets investor. And so, the idea of incomplete information today is, a small version of what we used to have to live through, right? And so, what that means is you spend more time trying to focus on what's really important. What are the things you do know? What are the uncertainty bands and probabilities of what you don't know? And so, we spend a lot of our work in our investment committee conversation is around probability distributions and outcomes and confidence intervals. And all of that sounds slightly quanty, but infrastructure is not a known future. And these assets and these businesses are on journeys. And if you imagine a set of where they may be going, and you don't know which of the things that they're going to go to, you can then create a way to have an analytical conversation. And so you're able to make decisions in high uncertainty. And you can then evaluate whether your analytics were right later. But that's a way to get out of the box, because you are largely living in a series where you don't know what you wish you knew. And so what are the things that you think, and how strongly do you think that they are likely? And if you're right, what happens? And if you're wrong, what happens? And you can then lay out a metric that, it's not nearly as simple and as neat as, what a merger arbitrage probability tree looks like, but it's not dissimilar thinking. And that lets you get out of this question of imperfect information.
If we look at, building an investment firm, we tend to notice that it's not just about, capital and deals and just doing good investment, but it's also about, shaping culture and also the process of decision making, and really have a DNA for the firm that you've built. Would you mind sharing with us, the principles that guided you as you were building Vision Ridge?
If you start with, there are a couple of key pieces, right, where investment excellence is first and foremost, and doing that with creativity, doing it with curiosity, right? You have to really want to dive deep into these sectors to understand them, to be willing to do the work, to be in places that people perceive as more challenging places to make money. You have to actually care about impact, right? I think it creates real alignment. It creates more motivation, a bit more passion. And so, when you have those two things, then the third layer is, okay, well, what are we as people and as a firm? I think the senior leadership of the firm finds this activity fun, right? If you don't find this kind of work at the end of the day fun, the hard work that it entails is grinding. And so we actually try to have a framework of fun. And then finally, you really do have to care about people as individuals. During COVID, we started a process of just fully shutting down the firm for a few weeks. And the way I measure it is our Slack traffic drops 95%, right? We can't go all the way closed. But if you go on vacation and everyone's working and you get back to your hotel room and you open your phone and you have 8,000 messages, that's really anxiety producing. It makes it hard to actually get away. And so if you shut down briefly, and everyone tries to shut down, and you've told all your partners, don't bother us unless it's an emergency, you both test the quality of your management teams, you test a lot of your systems, but it also is a pathway of saying, we're in this and we're working hard, but we also want to all make sure we get the kind of breaks that we get. And so to us, that's that mixture of love what you do, enjoy doing it, but also try to appreciate the kind of humanity of the challenges that we take on in doing this work.
Reuben, thank you so much for your time. We've reached the end of this interview. Final question I ask, all investors in climate investing: what's your least favorite source of energy?
Coal. Coal.
Okay.
It's just the most emitting source of energy there is. It's easily replaceable, and we don't need it anymore.
Thank you so much.
Thank you. It's been a pleasure.